Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, June 27, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And there are no surprises here today. We were talking about the bearish pattern that was developing from a short-term basis over the last couple of days. And as you can see, that played out today. Maybe it has a little more downside to go. Maybe it's complete. Either way, if it has more downside, I really don't see the market going below the 240.75 or even slightly below that. Now is the 50-period moving average. That's just basically 30 cents below that. So for all intents and purposes, I think the majority of the downside is done. We may see some more drifting lower throughout the remainder of this week. And considering that it's a shortened week, just from the perspective of a lot of traders and hedge fund managers, mutual fund managers, institutional traders and investors will be most likely not playing ball on Friday. So any way you look at it, my expectation is that the market's going to find low over the next day or so if it hadn't today. And we should have one more rally leg higher, and that's designed to fool as many people as possible, and so is this drop today. But we knew this was coming. We talked about it several times. We had the number identified. We didn't quite get there today, but we came close. And therefore, everything is going pretty much according to plan. What happened today doesn't necessarily eliminate the bullish pattern that's developed from a longer-term perspective on the SPDRs or the S&P 500, and here we have an up move, and all this is a pullback pattern. That's what's culminating right now. It's just a pullback. All we did is come back to retest a breakout point. You see this right in here where this level is, and we'll call it the low of this candle was 241.64. We came slightly below that today. We just came back to test a former consolidation point, and then we had a breakout, and all we did was come to check back in at that level. That's all the market did, nothing more, nothing less. It's very common and normal market behavior under normal conditions. Now, let's widen this a little bit and say, well, can the market have a big wide open break, and can we have, a big, horror show on the downside? Well, anything's possible. Certainly we can. Something can hit overnight. Some kind of event, a black swan type of news event, that can certainly jolt the markets and send the markets in a tailspin. We know from a longer term perspective, they're extremely overbought. We also know that from a cycle perspective, we're now in the zone where we're going to expect at some point in time, either now all the way up through the beginning part of August, we're going to see a more meaningful correction develop or begin in the market. Did that begin today or yesterday? It's possible. I don't think it did. I think there's still another leg higher coming, but anything can happen, and therefore we have to be on guard. Obviously, if that happens, I'll notify you here because there are numbers on the downside that if we break, it'll become very apparent and clear that the market isn't going any higher from here. So we'll just take it one day at a time. But as it stands, the market's doing exactly everything we discussed in these videos that it was going to do. So there are no surprises. It's going to plan. The question I get is there a buying opportunity down at the 240.75, 241, 240.50 in that zone? Is there a buying opportunity for a several day to even a couple of week rally in the market? And the answer is yes, as long as you're willing to take the risk. And here's the risk. The risk is, and this is the way I'm going to look at the immediate risk, a close below the 50-period moving average on a daily chart closing basis. That will tell me to not be long and wait for some other signal if and when the market's going to rise one more time. If we bounce off this level, okay, then I do think there is one more leg higher, but a close below the 50-period moving average is going to give me pause. There are other numbers on the downside. We'll get into those if necessary another time. I don't think it's necessary right now. As it stands, I don't have any lower prices in my expectations today. Doesn't mean it can't happen. I'm just not expecting it. But certainly, if we begin closing hourly first, below the 50-period moving average, then that's going to be the first sign that there's more downside coming and you don't want to be long the market. So that's the way you can play it if you're looking for a bounce to higher prices. And that bounce can certainly come after the 4th of July holiday weekend. We could sputter around up until that point, show up after the 4th of July holiday weekend, everybody forgets what happened the week before, and the market starts rising again for another couple of weeks. That could certainly happen, but keep in mind, we are in the zone where the market will enter a corrective phase that will be more meaningful than anything we've seen in quite a while. All right, let's head over to the IWM and take a look over there. Well, the IWM, by the way, I'm sorry, I always do this because I forget to talk about the volume, but I want to do that. Go back to Spider, we'll talk about the volume. And the volume, we saw an uptick in volume today. We're about 80 million shares, slightly above the 90-day average volume. You can see down here, we're going to finish out about 80 million shares. And you can see when you get an uptick in volume on the down days, that means there's more participation on the downside, and therefore it's indicative or tells us that when the real selling pressure comes in, we're going to see an extreme pickup in volume, and at the same time, we're going to see an extreme pickup in volatility, and we're going to see an extreme pickup in downward selling pressure in the market. Back to the IWM. Now, the IWM didn't have tremendous volume today. It certainly was an uptick, but still below the 90-day average volume. And I'll tell you, that to me is an indication that there's not a bloodbath ahead of us. If the IWM was really poised to lead the market significantly lower, I think it would have been down more than 0.7%, and the Spider was down a little less than that. So they were on par today. So I don't see the IWM leading substantially on the downside. That also tells me that this is still, or we're still in the midst of a pullback, not necessarily in the beginning stages of a bloodbath. The IWM wouldn't turn bearish unless we closed below this green candle low, which comes in at 138.74. A close below 138.74, and we also have our line at 138.60. We don't really need that anymore. Actually, you know what I'm going to do? I'm going to move it to 138.74. It's a better number today. You have the 50-period moving average. So this chart still remains bullish until and unless we close below 138.74. Pretty simple equation. If we do, it's bearish. If we don't, it's still in a bullish formation poised to go higher. I want to talk briefly about the VIX tonight because as we've been discussing with the VIX, each and every time it gets down below 10 with a 9 handle or even a potential 8 handle, it becomes a buying opportunity. I've mentioned that several times. And therefore, whenever we get below 10, you can look to collect the VIX, but you have to do that either with the exchange-traded products that are the either leveraged or unleveraged funds, like VXX is unleveraged, and then you have some others that I don't know them off the top of my head that are leveraged, and you can also do it with call options on the VIX. They do sell call options on the VIX itself, and with that, you're essentially preparing for an explosion in volatility that will come over the next 2 to 3 months in the market. Currently, I'm not long the VIX call options. I was waiting for a little bit lower price, didn't get it. I'm also waiting on time. I really think the opportune time is more towards the middle part of July, so I'm trying to hold out until then, thinking that we will get one more rally in the market and we will see an 8 handle on the VIX. Whether we do or not remains a mystery. However, in the 9s again, I'll probably start thinking about collecting some call options on the VIX. That's my plan. And by the way, just another piece of evidence for us on the bigger picture across the market, I do have a couple of call options on my screen that I'm watching on the VIX. I have the October call options, 2 different strike prices, and I'm watching them. And, today they really didn't move. Maybe one moved a nickel and one moved 3 cents. So that being said, that tells me, and they're far out, so that is part and parcel to the reason why they didn't move that much. They're several months out. However, that tells me that the VIX isn't necessarily poised to explode higher just yet. And potentially it's married together with the one more leg higher in the market conversation. We'll see if that remains a truism or not. But when I watch the call options on the VIX, the fact that they haven't moved, the longer term call options haven't moved, tells me that it's not necessarily ready to explode yet. You don't have the buyers stepping in there yet, the institutional buyers that typically have a leg up on most everybody else. And therefore, I think that's still one more opportunity for the VIX to come down into the 9 handle, potentially even an 8. We'll see what happens. Let's move on. I want to talk about the transports. And the transports really, they were down today, but they really didn't take a bloodbath today. They're obviously contained by this bearish pattern here that we saw. And we said yesterday, we made an attempt at the high here was 94.68. So we made that attempt yesterday. Today we came down a little bit, but all in all, the transports were only down 0.6%. And as one of my 2 favorite leading indicators, it's more evidence to me that there's not necessarily a bloodbath in sight. I could be wrong, but that's the way I'm reading the market. I think that this is a normal garden variety pullback across the markets. I just don't think we're ready to start the real bear phase just yet. But I do want to bring up another chart, which is the NQ. And this is the one we were looking at, and we saw the big down move on, when was that? That was on the 9th of June. And then we started going sideways. And I said, this is a bearish pattern. Until and unless we close above the highs, this is a bearish pattern that will generally play out to the downside. We've seen this, hundreds, thousands, dozens of times, depending on how long you've been here, happens all the time. And this is exactly what's happening. We rode the 20-period moving average, couldn't really get above it except 1 or 2 days, and then we broke down and now even closed below the 50-period moving average. That's your blue trend line. If we see much more selling pressure in the NASDAQ, you're going to find support down at this pivot low here or before, 55, 58. It sounds far away. It's about 120 points away. But in terms of the NASDAQ, the air can come out of that index rather quickly. We were down 100 handles today, and, things really weren't that terrible out there. So the NASDAQ is super inflated, extremely overbought from a long-term perspective. So for the NASDAQ to come down another 100 handles is not out of the question. And I do believe that we have a pretty fair chance of having the highs in for the year in the NASDAQ right here, right now. Even if we do have another rally phase in the market, there's a chance we don't make new highs in the NASDAQ. We don't really have to worry about that right now. But as we can see, this bearish pattern is playing out, has played out, and probably, technically speaking, doesn't really have that much more to go. This pivot low also, 56.40, that'll provide a pretty good level of support. If we break that, then we'll go down to the next level. But 56.40 would coincide with, and I'm going to bring back up the spider chart, that'll coincide with the 247, 241 area, the 50-period moving average. In this zone, if the S&P comes down farther, the SPY into this zone, then the NQ you'll most likely find in and around that 56.40 level, which would also create a buying opportunity in the NQ or the triple Qs or the NASDAQ, however you want to play it. But if the NQ hits that number, then that's also a potential another buying opportunity if we find support at that level. Any hourly close below that level, and then of course a daily close below that level, wipes out that conversation. However, we should find considerable support at that level. We looked at this a few times over the last week or so. We had the Philadelphia Semiconductor Index, and you can see here we had that bearish pattern. The bearish pattern played out to the downside. You can see where we're going for. We're going for this area here, right around 1030. We talked about this at least once, maybe twice over the last week. So this is playing out as planned as well. Again, same story as the NQ. The SOX was hammered pretty good today, down 2.7%. That's quite the thrashing, and that's indicative of the fact that the tech sector has been severely overbought. We have a very top-heavy weighted index in the NASDAQ, and you have some of the semis in particular the Nvidias of the world, just in a screaming runaway bull market. Look at this. Just take a little sabbatical from things. Look at Nvidia. This thing at the highs, this chart doesn't even do it justice. You can see this bearish pattern playing out too. But look at the monthly chart. And here you're putting in, look at that tail, you're putting it on a monthly chart on Nvidia. That's pretty fantastic. If we close the month with a tail candle and get any kind of a retracement in the month of July, that will be a stone cold short with both hands. Look at the weekly. I mean, look at this perpetual move higher. So this is overbought. These things are not sustainable. When you go from, let's say, May of 2017, right? That's just last month, okay? May of 2017, a low of 104, and just weeks later, you're at a high of 168. That's ridiculous. That doesn't happen under normal conditions. So that's why these things, the air will come out and they will come back to a sense of normalcy. All right, let's get back on track here. We're looking at a chart of gold. We saw a little bit of a bounce in gold, but what we're doing here, and it should seem pretty obvious after all the bearish patterns that we just looked at across the market, what do you have here? You have a down move, a little bearish wedge pattern, and likely story is you're going to play this out to the downside. I just can't see it another way. There's a ton of overhead resistance with the moving averages at 1260 and 1265. You have a lot of chart consolidation. You've already filled a gap here. It's almost, and I'm reluctant to say this, but I'll say it anyway, there's almost only one way to go for the gold market, and that's down. The only question for me is, does this trend line hold? And the way I see it right now, because we've consolidated over this trend line for several days, my vote is that it won't hold. We just won't know it until we get there. But if I had to say where we're headed on the downside, I would have to say we're headed a little bit lower, but not too much lower. Maybe 1225, 1230. This trend line's going to come in, well, right about 1230. So maybe it does hold. Maybe we just pierce it intraday and we bounce higher. That's certainly a possibility. A close below that trend line will be a negative. However, let's see what happens if and when we do get down there. There's a chance that that holds on a closing basis, but on an intraday basis, I have to think we're going to pierce through it. That's my take in the gold market. Looking over at silver, same chart, same scenario. It looks to me like a bearish wedge, a dead cat bounce, lower prices coming. We did a little shimmy down and test yesterday, but I don't think that's it. I think they're going to follow suit with each other, and I think there's one more flush coming in the metals, and then we'll find some semblance of a short-term low and potentially create a tradable opportunity if we get a reversal that we can trade against down there at the low. If we can get some kind of a signal, a reversal candle, doji candle, engulfing candle, then we have a low to trade against. You know where you're wrong. Those are the trades we want. Right now, just let it happen. Let it fall if it's going to fall, and we'll see if there's an opportunity when it does. Crude oil continues to get a bounce higher. Crude has the ability. In fact, where did we go today on the high? Today's high was 44.44. I think we talked about 44.50 last night and then 45. What was this high here? 44.69. So that high was almost challenged today. We didn't quite get there. That high has the ability to be challenged. Crude oil still potentially could have higher prices coming in the short run. Look, we could have the low in. We just didn't put in a bona fide reversal from the low, but it could be in if we close above this red candle high, which is 44.69. Then I'm going to say, at least for the time being, the low will be in. Until and unless that happens, it's a bearish wedge. So it's up in the air. There's no trade here. We need the market to tell us what to do. If we close above that level, then I think the lows will have be in, and we'll look for a pattern to trade against or off of. But right now, until and unless we can close above there, it's just a bearish wedge pattern. So we're not going to do anything with crude oil. Just let it fall if it's going to fall. Let it rally if it's going to rally. And we'll play a pattern when we see one. Now here's the bond market. And you can't make this stuff up. I'm talking about the fact that it's unlikely that the bond market rallies and the stock market rallies at the same time. So be it. That's what's been happening. So the bond market's rallying, and all of a sudden, the one day the bond market decides to have a reversal, come down and test, or at least almost make an attempt at the 20-period moving average, and we take out 3, 4, 5 days of upside, the stock market comes down the same day. You can't make this up in a storybook. If you asked me yesterday, or told me yesterday that the stock market, that the NASDAQ was going to be down 100 handles, okay, and the S&P was going to be down 20, the Dow was down 100, what would the bond market do? I think 99 out of 100 times I would say, well, the bond market will most likely rally, especially since we're in an uptrend. Why not continue the rally? And here we have it. The market's job is to fool as many people as possible, as much of the time as possible. And that's basically what we have here. Stock market comes down and we have a reversal day in the bond market. So we'll see where it takes us. Potentially, it could be a one-day wonder. I still think there's higher prices coming in the bond market. It's just not going to go in a straight line. So it was obviously overcooked on the upside. But technically speaking, there's no damage done on the daily chart at all. We just had a reversal day. We came in to test the 20-period moving average. But at the end of the day, we stayed inside on a closing basis, the low 155.9 from the 20th. So therefore, it's still a bullish pattern anyway, until and unless we get below the moving averages, then I'll change my tune. But right now, it could be just a one-day wonder in the bond market. Overbought condition stands to reason that it was going to come down pretty hard at some point in time. Today was that day, down almost 1% in the bond market. And the last market we're going to cover tonight is the dollar, which took one heck of a wallop today. Now, this is interesting. Now, obviously unexpected for me, and you all know I'm long the dollar. Interestingly enough, we'll see if they break these lows. If they break these lows, we're going to have to go back to the drawing board, and I'll find another level on the downside that we would have to achieve. But right now, the way I look at it from a technical perspective, until and unless we close below the low of this tail candle here from the 14th, then it's still in the same pattern it was yesterday, even though it certainly doesn't look like it. And let me qualify that. It's not really in the same pattern it was yesterday. Yesterday it was a bullish pattern up here, okay? But all in all, as long as this tail candle low holds, then nothing's really changed from the long-term perspective. Do I think it's going to hold? At this stage of the game, I think it's suspect. It's 50-50 at best. So the answer is I really don't know at this point in time. I won't be surprised if it doesn't hold. We'll leave it at that. It still doesn't change my long-term outlook that higher prices, much higher prices, are coming in the dollar over the longer term. Yes, this was a surprise to me, but it is what it is. Woke up this morning to one heck of a rally in the euro, and we just have to deal with it. The market hands you a deck. It hands you or I should say it deals you a hand, and you've got to play the hand you're dealt. So we'll see what happens with the dollar tomorrow. If we break that low on a closing basis and we close below that tail low, back to the drawing board, I'll come up with some new numbers. If we don't, then the tail candle is still intact and everything remains the same. It was just one heck of a sell day. That's it. We'll see what happens over the next day or so. And with that, I'm going to wrap it there tonight. It's everything I wanted to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.